Good evening, everyone. I'm pleased to welcome you all to this conference call to discuss Q2 and H1 FY19 results. Our results material have been uploaded on our website, and you may like to download it and refer it during our discussion. The discussion today may include some forward-looking statements, and these must be viewed in conjunction with the risk that our businesses face. On the call today, we have with us our Chairman, Mr. Ajay Piramal, Mr. Vijay Shah, our Executive Director, Nandini Piramal, Executive Director, and Mr. Khushru Jijina, Managing Director of our Financial Services business. With that, I would like to hand it over to our Chairman and would request him to share his initial thoughts. Over to you, sir.
I'm pleased to announce another quarter of robust performance by our company. For the second quarter of the current year, we have delivered revenues growing by 24% to 3,144 crores. And for the first half of 2019, the revenues grew by 26% to rupees 6,047 crores. The reported net profit for quarter 2 grew by 25% to rupees 480 crores. Our normalized net profit for the first half of FY 2019, excluding non-recurring and non-cash accounting charge towards imaging assets in the first quarter, grew by 26% to 863 crores. For the first half, the company has delivered a 4-year revenue CAGR of 26% and 4-year normalized net profits CAGR of 73%. We have been consistently delivering 20% plus growth in revenues and net profit for the past 12 quarters. Let me now take you through to the performance of the financial services business. During the quarter, our loan book grew by 59% to be at 52,800 crores versus 33,260 crores at the end of the second quarter of financial year 2018. Our NPAs, our gross NPAs based on 90 DPD remain healthy at 0.5%, and we continue to maintain a healthy provision of 1.74%. The ROE during the first half of financial year 2019 is 19.6% on a cash tax basis, despite the allocation of 5,000 crores of equity from the capital raise carried out in the last year. Last quarter, our long-term debt instruments were assigned a rating of CARE AA+ stable by CARE Ratings. In Q2, I'm happy to announce that ICRA has also upgraded our rating to ICRA AA+ stable from AA positive. You would recollect that many of you were in the Financial Services Day which we had in August. At that time, I had mentioned that because of the high valuations that financial services companies are getting, people are indulging in reckless lending. And it is high time that we start distinguishing between the good players and the not-so-good players in this space. My concern at that time was that if there was a blow-up in the NBFC space, it could affect the entire sector, and there could suddenly be a clamp down on funds, particularly from banks and mutual funds. This is what has been happening over the last few weeks. The default by ILFS resulted in a liquidity tightening situation across the NBFC sector. there were fears regarding availability of adequate funds to NBFCs, significant rollover risks with respect to borrowings, and asset liability mismatches. First of all, ILFS is not just an NBFC. It is of the total loan book of approximately 100,000 crores and more, the NBFC is only 20,000 crores, whereas the balance is in infrastructure such as power, roads, waste management, etc. And hence we need to recognize that even if 25% of the NBFC book, which is just mere 5,000 crores, which is insignificant in the total system, even if that was an NPA, it does not mean that the whole sector should get tarnished. But what has happened is, during the last 1 month, banks and mutual funds have become very selective towards which NBFCs they want to finance. Based on the way the NBFCs were dealt with the banks and mutual funds towards providing liquidity in this period, we could classify them into 3 categories, the NBFCs. The first category of the best-in-class NBFCs, which have low leverage, sufficient equity, good promoter reputation and commitment of skin in the game, strong and consistent performance track record. This category has been getting enough funds even during the peak of the liquidity tightening situation. Despite that, their cost of borrowing might have gone up marginally. The second category of NBFCs, which are good at the various parameters that I just mentioned, but not among the best in class. For such kind of NBFCs, liquidity is available, but at a significantly higher cost. And finally, there is the last category of NBFCs, which are performing average to low on these above parameters, where they are not getting liquidity or enough liquidity. This situation, in fact, is forcing them to sell a part of their assets or businesses. You will recognize that we fall in the first category. For instance, we are amongst the only 3 non-banking financial institutions out of nearly 30 major NBFCs which received additional bank lines from a large PSU bank at the peak of this liquidity tightening situation. During the Financial Services Day, I had also mentioned that the PEL board and chairman has 4 major responsibilities with respect to our financial services business. First, an effective risk management and ensuring a healthy asset quality. Second was maintaining ROE of 20%. Third, ensuring that there is the right people with the right set of values and culture. And fourth, maintaining an adequate liquidity for the business. And this is what we have been focusing. And let me address each of these issues. As far as our liquidity is concerned, we've always been conservative and maintained sufficient liquidity in the form of cash and several bank lines, which were more than 7,500 crores as of September 30th. We got additional bank lines of 2,200 crores sanctioned since the last week of September in this quarter, and we expect to secure additional bank lines of 7,000 crores. I'm also happy to state that during this period, 70% of the CPs which have been matured have been come back to us. Additionally, we are also working on measures such as additional bank lines, ECB issuance Euro medium-term loans to further boost our liquidity position going forward, which Khushru will talk in more detail. Why were we well placed during this liquidity situation is a question that would arise. And I'd like to explain to you why this is so. One is that we have allocated sufficient equity of 20,000 crores to the financial services business on a loan book of 53,000 crores and hence have a very conservative debt-equity ratio. Because of our conservatism, you would recollect that we raised 7,000 crores of equity last year, in October of last year, through a QIP and a rights issue, at a time when many people felt that we were being too conservative in raising so much equity because our ROEs would have fallen. But we felt that it is always better to be prudent, and I think this is why we are in a more comfortable position today. Out of this 7,000 crores, 5,000 crores were allocated to the financial services business. The second and more important point I wish to bring to your attention is the strong commitment that the promoter group has. We as promoters continue to hold nearly 50% of equity in the companies. The promoters have never sold equity in the company or have invested outside the businesses owned by the Piramal Group. Even during the recent capital raise, promoters subscribed to the rights issue at the same price as what all the other new investors come in. In fact, if we compare PEL with any other large financial institution in India, Piramal Enterprises has the largest effective promoter shareholding, which is skin in the game, is highest for us than any other promoter of a certain size and scale in the financial service business in India. We've always been conservative and maintained a low leverage. Currently, the debt to equity is 4.4, and it is even lower if we include our investments in the Shriram Group. It is then only 2.6. In fact, we are today amongst the lowest leveraged NBFCs of India. Even after the fundraise, the ROEs today are at nearly 20%, which continues to be among the best-in-class performers across various banks. There have been questions on asset quality, and I thought I will just address these as well. We follow the best-in-class risk management practices. The key practices would include: we have independent risk and legal teams which report directly to the board. External experts are part of our deal clearance committees and the board risk committees. Unlike most other NBFCs, 100% of the deals that we do are secured and 100% of the deals have escrow over the future cash flow of the asset. We have a robust risk management framework along with stringent controls and review mechanisms, which you would recollect we had discussed in detail in the Financial Services Day. And this has helped us maintain the best-in-class asset quality. Our gross NPA ratio has been below 1% for more than 10 consecutive quarters. As of the 30th September, our gross NPAs were only 0.5%. However, we continue to remain conservative in terms of our provisioning and have maintained a provision of 1.74% on our loan book. With the kind of business model that we have developed over years, even in the worst situation, That is, if a developer defaults on any payment or delays the payment beyond the regulated timelines, we have the ability to take over, complete, finish, sell, and recover our money. This is, in our mind, a unique ability, which I generally call as a nuclear option. So, we don't see any reason for us losing our money on any of our accounts. As discussed during the Financial Services Day, we also have a well-diversified borrowing profile with more than 100 investors, including banks, mutual funds, FPIs, insurance companies, charitable trusts, etc. I would ask you to actually refer to the investment deck for detailed disclosure. Coming to the asset liability management, our ALM is well within the regulatory requirement. As on 30th September 2018, we had a positive gap across most maturity buckets. Our cost of funds on incremental borrowing has increased by a mere 50 basis points recently as a result of the liquidity tightening. This increase in our funding costs has been lower than most large NBFCs. We continue to have a healthy mix of fixed and floating assets and liabilities, which limits the impact of a marginal rise in the interest rates on incremental borrowing. As of 30th September, 47% of our liabilities, while 46% of our assets were floating in nature. So we can pass on the rate increases to our customers. I want to comment on our partnerships. We have several long-standing partnerships with trusted and top-quality strategic partners and investors who are a perpetual source of capital for us. So if I was to summarize, I think we are amongst the best-in-class non-banking financial institutions in the country across all key performance metrics, and hence we are getting adequate liquidity in the most difficult of times, and our asset quality is still very good. I will now ask Mr. Jijina to go into the details of the financial services performance.
Thank you, Chairman. Good evening, everyone. Before I talk about the business performance in more detail, in continuation with what Chairman just mentioned, I would also like to go a little bit in more detail on our status in this liquidity tightening situation. As Chairman mentioned, clearly the banks and mutual funds treated different NBFCs and HFCs very differently in the last few weeks. So looking at our performance track record, equity in the business, and promoters' commitment, as Chairman just now mentioned, we were well positioned to get liquidity from various banks and mutual funds. In fact, there were institutions with whom we didn't have prior relationships, and they actually started approaching us to take more funds from them, which I'll talk about it in a more detail in a minute. As Chairman already mentioned, at the cost of repetition, at the end of September quarter, we had cash and cash equivalents and undrawn bank lines of nearly 7,500 crores. With respect to ALM, we were well matched across all maturities buckets and actually much within the regulatory norms. Here again, I would like to bring about a point that it is not as on end September only. If you go back to any quarter of our financial services, we have always been well matched in the ALM. In fact, as you know, Reserve Bank of India allows a mismatch up to 1 year 15%. We have not availed that in any quarter till date. Bank borrowings, as the Chairman spoke about, they continue to remain a significant portion of our borrowing mix. As on 30th September, we had 47% of our borrowing from public and private sector banks. During the last 1 month, since the trigger of the liquidity tightening event, we got additional bank lines worth 2,200 crore. Again, it is worth mentioning here that banks who were previously not in touch proactively approached us with new sanctions. Commercial paper. Out of our borrowing, rupees 6,300 crore were in the form of commercial papers. We could comfortably raise commercial paper in the last 1 month to an extent of 1,500 crore. And as on date, our outstanding is only 5,900 crore. If you recollect, it's in the last 2 quarter calls, we have been saying this, and I'm repeating this, that post the completion of the reverse merger in June quarter, our endeavor has been to continuously increase bank lines and also work on alternate sources of funds. We said that even in the presentation on the FS day. Coming to the borrowing cost, Chairman already mentioned that our borrowing cost for the quarter was almost similar to that of Q1. The incremental borrowing cost saw a very marginal increase. However, given the fact that our floating rate liabilities and assets are fairly matched at approximately 46% each, we were able to pass on most of the increase in our borrowing cost. In the recent 1 month, thanks to the liquidity and crisis and the cost of funds going up, we actually passed on the cost because of the increase in the cost by 50 basis points. So we actually passed it on, and our retail lending we increased by 15 basis points. We continue, however, having said that, we continue to remain focused on our liquidity position over the next few weeks, and will also work towards getting additional liquidity pools from domestic as well as global markets. Chairman already spoke about 2,200 crores of bank line. Over and above that, we have just contracted rupees 2,000 crore of domestic issuance through 2-year NCDs. Let me go back to what we presented to you on the FS day, that thanks to the reverse merger, the lines of ECB has now opened up to us, and as you know, $750 million per year we can raise. And we had started work on it right in August itself, and I'm happy to inform you that in the next few days, or I would say in this quarter, out of the $750 million, we will be actually issuing ECBs of $250 million. I also mentioned on the FS day that we are looking at a dollar bond issue of $1 billion, if you recollect. Here again, let me report the progress. We are almost in the final stages of securing the international rating from S&P and Fitch, and probably in the end of December, beginning Jan, we'll be on the road shows for that. I mentioned just now to you that one of the positives of this development was that we had a lot of banks whom we were not working with before coming to us and asking us whether we want more lines or new lines. And as we speak, we are in advanced stages of concluding 7,000 crores of lines in this quarter itself. Let me move on to our business performance during the quarter. The overall financial services performance, Chairman mentioned, but I will repeat a few numbers. Our loan group grew 59% to 52,800 from 33,200 in this quarter, on the back of growth of all business segments, especially the corporate finance group. As always mentioned, we continue to go down the risk profile through the launch of multiple lower risk and products and the introduction of new verticals. Our gross NPA ratio as on quarter continued to remain low at 0.5, and we continue to maintain a provision of 1.7% of our loan book. Another very important data point I would like to share with you, that during this quarter we received 4,100 crore in terms of repayments, which is almost 42% of our disbursements of this quarter. And more important than, from the time this mayhem has taken place in the last 30 days, you'll be happy to note that we actually got repayments of 1,350 crore. Let me move on to the real estate developer financing. Our real estate developer financing loan book continues to see good growth of 44%. Today the book stands at 38,700 crore. And we have been saying this for the last 1 year in the line of earlier stated strategy of moving down the risk profile. Construction finance and lease rental discounting continues to lead this growth. Today, construction finance accounts for 60% of the RE book, and the LRD book has tripled to 5,000 crore. You would recollect that we had also mentioned that we are focusing now on LRD deals in hospitality sector. Happy to report that we have now crossed 2,000 crores in lending in the LRD. It's like against the revenue of the operating assets which are more than 5 years old in the hospitality sector. Corporate lending through CFG and ECL. ECL is the emerging corporate lending, which is basically to mid-markets. As we had mentioned several times earlier, and we have been saying this from last April, again CFG clearly came out as the biggest growth driver by crossing a book size of 10,000 crores, a growth rate of 76%. If you recollect, we had mentioned in the last quarter that we are now concentrating on other fee-based income. And I think we said it in the FSD also. And we mentioned two verticals which we were looking at. One was the asset aggregation strategy and one was the AIF for structured debt deals, which we would do it on the AIF platform for corporate finance group. I'm happy to inform you that the work on both of them have actually already started, and we will continue to keep you posted on the developments. Our emerging corporate lending group, now a year old, has grown 4 times to 1,500 crores in September 18. Housing finance. In fact, incidentally, we completed 1 year of our housing finance since we got our license on 4th September 17. Our retail loan book as on September 18 is now 2,325 crores versus 202 crores, which was at the end of September 17. And in the quarter, we disbursed 811 crore. Over and above, we have loans approved but not disbursed in housing finance of 1,700 crore. Our LAP portfolio out of this forms only 156 crore. Now, why am I mentioning that? Because again, consistently we have been mentioning on our calls that we will not pursue the LAP as is being pursued by everybody. If you recollect, on every call we have been saying that we will only go by cash flow based LAP, and that is why we have not grown our book, because as you have seen in the market, there are LAP deals being done without cash flow back, and we will continue not to do that. Again, the proof of the pudding of HFC, which we keep on talking about, B2B2C, that it's basically based on our relationship, so end-to-end financing to the developer through HFC also, which is the last leg. 57% of our retail loans today are from existing relationships. Again, if you look at the mix, 57% is salaried and 43% is self-employed, with an average ticket size of 74 lakhs. Again, here I would like to qualify that since it was the Mumbai region, right till March, which was the mainstay, you see 74 lakhs as an average, which is a very healthy number. But as we have opened now several branches in other cities, you will actually see this number going down. But more than anything on this housing finance 1 year, while we are all happy with the growth and with the quality of the book, I think last time also we took you through one of the things in our wholesale book, which Chairman just now mentioned, which we are always very proud of, is our processes and our EWS, the early warning signals. And last time I did mention to you that we have now prepared our proprietary model for our housing finance to control the NPAs there, if you recollect. And I'm happy to say that we are using this, both the analytics and the EWS process, and today our NPA in retail housing within this whole year is nil. Let me move on to a topic which we have not spoken so far, and it is pertinent today to talk on that. Because we find that a lot of rumors floating in the market, we felt that for the benefit of our entire investor community, today we talk a little bit in more detail on the real estate portfolio quality and a few top developers. But before I go into that, again consistently what I've been saying, we have been saying that whether it was the various tsunamis which came in, whether it was RERA, whether it was GST, whether it was demonetization that hit the real estate sector, we have been consistently delivering strong asset quality performance of our book. So if we take a step back for a minute before I go into the details, what is enabling us to continue to maintain a healthy portfolio on our real estate portfolio? We have been saying, so I'm repeating the same points. One, the right developer and the project selection. Because we have been saying for the last 3 years that few developers will survive and you need to select the right developer who will grow. Again here, let me qualify what I mean by that, because people think that tier 1 means only big developers. I think I mentioned that on the financial services day. For us, tier 1 doesn't mean the big size only. You need to go granular into each micro market, and within that micro market, identify the developer who is managing his balance sheet, who is doing a good execution and a good quality product, and that for us is tier 1, and that is the developer whom we want to back. So, in our definition, if you take this definition, nearly the entire real estate portfolio today is with tier 1 developers. If you recollect, we had shared some data points with you, because again, last time, there were some rumors that Piramal is funding everybody. And we had shared this data point with you, that in the cities where we operate, we were happy to inform you that we only form 1.3% of the developers in that market. So it's not that we are funding everybody. And again, to logically say and to continue our logic that consolidation is taking place and only a few developers are selling, we had shared this data point that 7% of this 1.3. So basically our developers are doing 7 times better than the others. So which again brings to the point of consolidation. Today let me drive this point further, that we have done some more data analysis on this, and happy to report to you that our developer sales our developer sales I'm talking about have grown by 26% in this year compared to last September. Once again reaffirming our theory of rapid consolidation in the real estate industry. The second point, which I always speak about, that it is not only the developer, it also lies in the underwriting. We spoke a lot on the FSD on that. The third is cross-collateralization. What do I mean by cross-collateralization? Since before we enter any deal, and many of you would recollect some quarters back, I had mentioned this to you all, that before we do a first deal with any new developer, we actually go into the entire balance sheet of the developer. And then we select the assets which we want. And whichever assets we do, the various projects, we cross-collateralize it. Because at the end of the day, since we escrow 100% of the cash flows from every project, we can move the cash if one project goes slow. The fourth, is the rigor in asset monitoring. We have spoken enough of this all the time and the early warning signals. But again, let me share with you what I said last time. After the Reserve Bank of Audit, the comments which they made, and I would like to repeat that again in these circumstances. What did the Reserve Bank of India say? Is that in their entire so many years of experience, they haven't yet seen a 4-year-old NBFC having systems better than any NBFC in India. As you know, we are on the verge of completing our first NHB audit, because thanks to reverse merger, we are now governed under National Housing Board. And I would like to make a statement here in advance that I'm reasonably confident that the same remarks will be made by NHB, and which once the report comes out, we will share with our investors in the next call. And needless to say, the independence of legal and risk, which is so important in this business. Today, if you break up our loan portfolio, if you look at our 10 top developers, they form 42% of our portfolio. And let me tell you, each and every developer today standard, there is not a day of delay. Let me move into certain accounts which we haven't spoken, but because of the circumstances of various rumors, I thought it is important for my investors to know exactly what is happening. And this will also bring about some nuances, some color of the way we operate, all what I said about whether it's underwriting, EWS, etc. So let me talk of our biggest account, Lodha. Today we have an exposure of 4,300 crores to the Lodha Group. This amount is spread over 6 deals over several projects of Lodha. Today, the entire amount of interest and principal that was due till date has been paid to us. Not only are all our loans standard, but we are happy to report that in more than 90% of our loans with Lodha, we have been prepared for more than 12 months in advance already. So in other words, till October 19 to December 19, all the repayments have already been done, which were actually to happen over a period of time. The reason being very simple, that their sales and collections have been healthier than our assumptions, and we have, through our escrow, swept in the additional cash. Moreover, if one really looks at the portfolio today, it consists of more than 2,000 crore of sold receivables already and unsold almost ready to enter inventory, which will be completed in 6 months of 4,000 crore. And as I said again, all our deals being cross-collateralized and having an average cash cover of more than 2x. So, as you would have appreciated by now, that based on the type of underwriting, the selection of the deals, our assumptions, today, in fact, we are just getting prepaid month on month by Lodha, vis-a-vis the perception created in the market. I do get a very specific question of late, what happens if Lodha's IPO gets delayed? So let me answer that. I think we have said that again in the FS Day, that as a practice, we always keep our clients to keep their plan B ready, especially when there is a large liquidity event. Here again, I am happy to inform you, the plan B of Lodha, which we had worked on with them much before what happened in the market. Today as we speak, Lodha has already concluded their sale of their non-strategic assets amounting to 4,500 crores, which they will announce in the next 15 days. Unfortunately, I cannot divulge you the name of the strategic assets, non-strategic assets, because Lodha needs to do that. But I can confirm to you that that deal has been done. Lodha has already concluded project-specific private equity deals amounting to 1,000 crores, which will get consummated in this quarter. So the infusion of 5,500 crore, along with the net free cash flows, which is already being thrown in this year of 500 crore, which will go to 750 and 1,000 later on, are more than sufficient for the group to repay its obligations. Let me talk about Omkar, which is again, I keep on hearing a lot of rumors about. As on date, we have an outstanding of nearly 1,700 crore against two projects with Omkar, which is L&T Crescent Bay and Piramal Mahalakshmi. In both these projects, Omkar more or less has already fulfilled its obligations for land clearances, permissions, etc. And the repayment of our loan will actually come from the construction and sale of Piramal Realty and L&T Realty. And I'm sure you all know what is happening to both these projects. They are far ahead of our assumptions as of today. In fact, probably among the top 5 or 6 projects in Mumbai today. Our first investment in Omkar was actually in the early 1973 project. We had given a loan of 1,200 crore to Omkar against the flats sold by them under the 2080 scheme. So it was not a construction finance, it was just a receivable funding. This loan was actually due from June 19 onwards. And I'm very happy to inform you that since the handover of the flats by Omkar was faster than our assumptions, we have been fully repaid or prepaid from customer receipts, and today we do not have any outstanding against the early 1973 project. Let me move on to one more, which we keep on hearing in the news today, of late, is Vatika in North. Let me take you through our exposure there. As on date, we have an outstanding of 1,393 crore with Vatika, out of which 45% is actually against the operating cash flow of the established hotel in Gurgaon, namely Westin, which incidentally, if people from the north who are on the call will vouch with me, that is actually one of the best performing hotels in Gurgaon, and at an LTV of only 47%. The balance amount of loan was given against 3 projects, 2 residential and 1 commercial. Out of the 3 projects, 2 projects, that is 1 in residential and 1 in commercial, are in line with our underwriting of construction, sales and collections. There was a delay in the other residential projects in obtaining approvals by Vatika. However, even this project, I am happy to inform, is ready for launch now in this quarter because they are in the final stage of obtaining all approvals. But again, I am trying to bring about the point of cross-collateralization. Because of the cross-collateralization we had on all the deals, in spite of the residential project, which was an early stage project, we could recover our interest and repayment on time in spite of the delay of 1 year because of the cash flows we swept in from the other projects. So in the end, to summarize, as Chairman mentioned, going forward, our key focus in the near future especially, while as you would appreciate that this situation is actually separating the men from the boys, there is a growing opportunity in the medium term and long term. but in the short term, we will continue to monitor our liquidity position very closely. In fact, we believe our NIMs will actually improve because you would all recollect that in the last few months or the last year, because of the mushrooming of various NBFCs, there were deals being taken away from us because of lower and not they were not risk adjusted, and we were not ready to go down that path. So we actually believe that the NIMs will actually go up, and will definitely continue to maintain the best-in-class quality assets with robust risk management and asset monitoring. With this, I think I will give it back to Hitesh Dadda.
Yeah, we can have Q&A now.
Thank you very much, sir. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Thank you. The first question is from the line of Alpesh Mehta from Motilal Oswal Securities. Please go ahead.
Hi, good evening, and congrats on the good set of numbers. First question about this cross-collateralization. So what happens in case of a RERA? So assume, because in case of a RERA, for a particular project, the entire cash flow has to be escrowed to that particular project, right? So it can't be cross-collateralized with the other projects. So how does this entire mechanism work with that?
Yeah, so the cross-collateralization is on the 30% extra, which the overflow keeps on moving into the 30%, not the 70% bucket. So if the project, as you have seen, I demonstrated it in Lodha, if the money is more than enough for construction, then the additional amount under RERA can be swept into the 30% account of the developer, which is swept back by us.
Okay. Second question, some of the smaller NBFCs were financing the tier 3 to tier 6 kind of developers, and since they are facing the liquidity issues, do you see the impact of that on the smaller players? And in that case, what would be the impact on the entire industry?
No, so I think we have been saying this is a good question you asked. We have been saying this repeatedly in the last 1 year, and it's just increasing by the day, the consolidation. So I think we explained on the Financial Services Day that beyond lending today, we are marriage makers. So if you really see what's happening on this space from the inside perspective, is that these are the developers who have got no future. And they either have to sell their land or their brownfield projects, which is what we facilitate today at a much better price or a much lower price than what it was before for our developers' growth. So in fact, we are not only lending, we are also helping our developers grow based on the profile of the land, the micro market it is. So as I mentioned to you, we know who is strong in which micro market. So we help doing this marriage making. And in fact, we are a part of this consolidation in this industry today. And this will continue for some time.
Okay. Third question related to the current conditions and the liquidity situation. Would you like to revisit your growth targets or whatever we were expecting by the end of FY20 or 21? Do you expect that the numbers could be revised downwards looking at the current situation? Or it could be revised upwards?
So one is that we don't keep growth targets in the past, never have we kept them, and we don't want to keep them in the future as well. So that's one thing. Second thing is that, as we have said, our focus, as I said before, one is to ensure that the risk is contained, liquidity is always there, and we get an ROE. If we meet these objectives, that's more than enough for us. So that's what it is.
Okay. Another question, when we have presented the ALM profile, does this also include the undrawn sanctions from the existing bank lines, or it does not?
Yes, it does include.
It does include.
Which actually we have drawn.
Okay, so money is already there in the bank.
As a matter of prudence, we have drawn all the undrawn lines and kept it in liquid.
Okay, so the entire money is with you right now. There is no undrawn sanction from the bank. You would have just approached banks for the new line.
Yes, absolutely.
Yeah, I think we must appreciate one thing, that actually there is enough liquidity in the system. It's more a lack of confidence that people have. And therefore, the lenders, there is a flight to quality. Even the lenders are lending, but they are giving it to high-quality NBFCs, and we fall in that category.
Okay. And the way the cost of funds have moved for the NBFCs, at least most of the NBFCs have increased the lending rates for the developers. Do you think that this could eventually lead to some asset quality related issues for the industry? Because there has been a sharp rise of almost 100 to 200 basis points by most of the players into this segment.
I don't think there will be a asset quality deterioration because of this increase in rates. I think we've seen higher rates in the past as well. I don't think that will happen.
Okay. And just the last question now on the refinance market, because we were also earlier thinking of selling down some of our portfolios, etc. So what would be the impact of the current situation on the refinance market? And are the banks still willing to take the developer portfolio as a sell-down portfolio, or it's just the retail portfolio which is going as a sell-down portfolio?
Let me answer this. Well, when we had mentioned about downselling in our FS day, if you have seen, mainly it is on our corporate finance book, which is the non-real estate. And even there today, wherever we have approved the deals and sanctioned and disbursed, we have downsold already. In our real estate portfolio, we typically downsell LRD portfolios for the ROEs, and that's what we have been mentioning all the time. But since you have brought about this topic, let me really talk about, take 2 minutes on our underwriting and what we mean by this and this refinancing thing. Typically, if you really again break up our book, if you remove the LRD and the hospitality deals, you will see that out of the mainly 70% of our book is construction finance. And I have said this repeatedly, that construction finance is not as simple as it seems, right? We have said this repeatedly. And we have gone on to explain to you all many times that how construction finance, we look at it in the underwriting vis-a-vis many banks and NBFCs. But for the sake of many, let me repeat this, and because it's so relevant and today topical about it. So, today, first of all, before I get into the example, the point I'm making is that when we do construction finance, we ensure completion of the project. Very, very important. We are not dependent at any given point that if the sales slow down, what will happen? And I'll explain through an example. Or if something goes wrong, somebody will come in and give top-up. Because we will ensure, otherwise we do not get into construction finance of any project. Unless it's an SPV, separate, we have full control, and we have fully ring-fenced and given financial closure. So now let me give you an example which I have said it in the past for the benefit of many other people. So let's take a simple example that a developer approaches for construction finance of 100 crores. Now, when a developer comes to any institution for a construction finance of 100 crores, inherent in the assumption is the assumption of sales which he'll make and collection. So he doesn't require the entire money as loan. So let's take an example that he wants 100 crores of lending. He's assuming that he will probably sell 150 crores of goods. So basically his cost of entire construction is 250 crore. Now typically, I have mentioned this in the past, that NBFCs and banks look at an end-to-end 5-year picture and feel that construction finance being so simple that they will keep on lending as the stage goes up. But people forget that this is a quarter-on-quarter business. So what do we do differently? So when this type of deals come to us, first of all, we stress test it against the collections at various levels every quarter. And as you know, again here we have an advantage because we have a marketing arm called BrickX, which is in the B2B space of selling. So we get actually on the ground information. Today I shared some information with you all, right, about the data points. We could do it because we have the information. So coming back, so we stress test the collections and the sales. And if we are not comfortable, so let me continue. So for a minute, in the 5-year, we feel that in the 9th quarter, we feel that there could be deficit and the developer will slow down on construction. Are we happy to give that additional 10 crores over the 100 crores to help him continue the construction? Because the trick in this trade is that you need to continue construction and complete the project. Because with a 2x cover, you will be absolutely safe as long as you complete the project. And that's what we do. So if we are not comfortable with any deficit in even one quarter, we reject the construction finance deal. And many developers have scratched their head and criticized us in the past that why have you rejected a construction finance deal? And this is what I'm sharing today, will be so topical. And that is why we do not depend on any refinance. And that's why you see, if you pick up any of our construction finance deals in the last 4 years, you will see that the projects get completed and then the sales takes place. That is what we do. Let me take this argument a little further. We said this on the FS day, that probably we are the only NBFC in India who ring-fence the developer projects from the day of equity, in fact. In fact, because we are offering equity on our Ivanhoe platform, from the day he gets an equity, we enshrine the agreement that if he performs X, we will convert it to construction finance and then we'll convert it to housing finance. So I think today, to just bring home the point, when we do the funding of the project for our developers, we are not dependent on refinancing at all.
Thanks for all the answers. And just last 2 questions for Mr. Piramal. First, there was a media news about sale of the part of pharma business. Any comment on that? And secondly, from a regulatory perspective, what all changes are you expecting in the NBFC space? Thank you.
So first is very easy to answer. We just never comment on speculation. Every few days there's a news, either we are buying something or selling something. If I start doing this, you'll soon realize that we are a jumbled up business. So let's leave that aside. Now, what are the regulatory changes? I think it's still not clear what they're going to do, but my understanding is that the NBFC is a very critical part of the ecosystem of the country, and therefore the government and the RBI realize its importance, and therefore they have to see that there are no major shocks given. Just for your information, today the SME sector, the medium and small scale industry sector, forms about 31% of the GDP of the country, and 26% of total employment is in this sector. And this is a sector which is actually funded by NBFCs. Banks are not in a position to adequately fund this sector. So if there is a sudden clampdown on the NBFCs, the whole employment and the economy will come to a halt. I think the government recognizes that, and therefore whatever measures they are taking, and they are in deep discussion for that, they will keep that in mind. So overall, I think I'm optimistic that there will not be too many severe restrictions in the short term. Some changes need to be made, but I think they will be calibrated and over time. And the changes, I think, will be for the better. The stronger NBFCs will emerge out even stronger, and you'll be able to separate the men from the boys.
Thank you, and all the best for all in future quarters.
Thank you. The next question is from the line of Ajay Vora from Reliance Industries. Please go ahead.
Yeah, hi, sir. This question is to Mr. Jijina. Firstly, thank you very much, sir, for the detailed explanation on each and every account. I think it was very insightful and helpful. So my only question is, going forward, now with the reset in terms of liquidity which we are seeing in the system, will there be any different approach we will be adapting to take this forward, meaning the overall growth outlook what we envisage, or we will basically, go ahead with the same thought process? So if there is any change, how do you see the industry also shaping in terms of the real estate market? Because over years, what we have seen, whenever this liquidity situation gets tight, the first thing is people anticipating a crisis in the real estate market. And you would be the best just to, understand the whole market. If you can just explain how do you see that panning out?
So again, as I'm saying, this statement on real estate, everyone has been making for the last 3.5 years. We have been maintaining, and we are seeing it from the inside, that the whole industry is changing what it never happened in the last 70 years. That only the 10% will survive, the rest are dying. And that's what we have been saying consistently. And we are being hand-holding only those developers we believe will survive. So that will happen irrespective of this crisis. and the strong will get stronger. And in fact, just to add on, as Chairman mentioned, with this crisis, I think even in the NBFC space, you will see a consolidation. And we are already seeing it. I mentioned to you the bank lines, the banks coming to us. Coming back, what was your first point you mentioned?
Will there be any different approach?
So let me answer that. So frankly, in fact, as I mentioned in the end, in the last few months or a year, we were actually leaving the deals because we don't believe in giving deals at any rate. Ultimately, the rate has to be risk adjusted. And this is what was happening thanks to the mushrooming of small NBFCs. We believe that in fact our NIMs will actually become healthier now. So that is one thing which will definitely change for the better. As far as the growth goes, as Chairman mentioned, even I mentioned in our talk, that in the short term, we will continue. For us, the most important thing is managing the liquidity and being conservative. So in spite of actually on the ground, let me share with you, the opportunities have actually doubled in the last 30 days. But that doesn't mean that we will go all out and try to, because we believe in the medium term and long term, these opportunities are there. But in the short term, I think managing the liquidity, managing the NIMs and the quality of the book is paramount right now. So this is the same approach we'll continue. We are not going to go overboard on that.
Okay. So broadly, you don't see any major issue with the real estate sector as such, because many perceptions are that, this round robin of loans from banks to NBFC, which was going on, may get halted for a while, and therefore few, even smaller real estate guys can, get into trouble. So that cannot lead to some big problem. You don't.
So actually, let me, if I wear the hat on behalf of the industry, they are actually very happy. Because what was happening, because of this round robin and small NBFCs, the real consolidation was getting slower. And unnecessary supply is coming in the market at obnoxious rates. So in fact, this will clean up the industry faster. This is actually the industry view.
Right. Thank you very much. It was very helpful.
Thank you. The next question is from the line of Nischint Chawathe from Kotak Securities. Please go ahead.
Yeah, hi. This is about the consolidation that you mentioned in the in the sector and in the NBFC sector. Now, at this point of time, we are seeing that some of the NBFCs and in fact some of the larger HFCs are struggling on the liquidity front and sort of have been going really slow or sort of taken a pause in certain segments. Now, what really happens when such large entities kind of take a pause? How do you kind of benefit, or is there a contagion risk? Your thoughts on this?
No, I think as far as the NBFC sector is concerned, as I said, I think there'll be a flight to quality, and you will have people will start distinguishing between what are the good NBFCs and the not so good NBFCs. And in that case, I see that the demand, since the economy is growing, the demand is continuing to grow. So fund requirement will be there. It's not possible for the banks to actually meet these requirements. Ultimately, NBFCs will meet the requirements, the marginal ones will shut down, and consolidation will take place. Will there be a contagion? I don't think so. If it is, it will be temporary, but the system is aware of it, and they're taking measures, I think, to see that it cannot be widespread.
Sure. Thank you.
Thank you. The next question is from the line of Pritesh Chheda from Lucky Investments. Please go ahead.
Yeah, thank you for the opportunity, and thanks for giving the bird's eye view. In the whole discussion, there was probably one risk, which probably was not discussed. So, I'm just putting a question around that. That is a scenario such that is there a higher probability of an asset price or a collateral price revision, because it's about a 13-14-year cycle, where it hasn't probably happened? And if yes, then what will be our stress test on credit, liquidity, and solvency of our portfolio?
One is that it's unlikely that there will be an asset price downward revision. If you look at it, actually prices in real estate have not gone up for a while today. That's one thing. So So I don't see that suddenly there'll be a crash in prices. Even in the past, and in the last 3 or 4 years, if you see, there's not been any abnormal increase in prices. So I don't see that prices coming down on real estate. The way we also lend and the way we do loan to value, it's only about between 50 and 70% loan to value at the time of giving the loan. Also, we take pretty conservative estimates of price, lower than what any developer thinks. So will it affect if prices come down? First of all, I don't think they'll come down. If they did come down also, I think there's enough juice left for us, the difference between the value and the loan given, for us to be concerned. The other thing is that we talked about our asset monitoring or early warning systems. So we are doing this on a monthly basis to see what the values, what the sales is, what is the sales according to our assumption. And if there is an issue, we take it up front itself. So till now, I don't see there'll be an issue on pricing.
Okay. Just follow up here. Hypothetically, if that is to happen, then what are generally the steps taken by a lender if such a hypothetical situation arises, or what is the arsenal with a lender if such a situation arises?
So the arsenal that we have with us is very clear, because the way our legal documents are drafted, and we have complete charge on the assets that we have lent to. And the arsenal which we have, which most other people in the financial services do not have, is that we have the ability to take over the asset, to complete it, and to sell it. And that's where I think even with our brand name and our ability to complete projects, I think we will get out better position than what they would.
So to add to what Chairman said, that even say the products are ready and the developer is not able to sell at the rate because, as in your situation, markets have crashed, with our 2x cover, and we have demonstrated that this is not theory actually. Of course, it's not a crash situation. Wherever in advance we have seen that slowdown is happening and there could be he can get into a cash crunch, we have forced him to sell at lower rates. We have actually done it multiple times, not once or twice. And that's the trick. At the end of the day, you have to be on top of the curve. You have to monitor. You have to understand the nuances of real estate more than lending. And that's what we do all the time.
Okay. Just follow up here from the discussion itself. One of the participants had highlighted about round robin in the funding side, for the past few years. If I just take that observation, and if we are also highlighting that not all developers might get financing and not all NBFCs would be able to participate. If that's the situation, and if a round robin observation was there, then why do we have observation as asset price or collateral price will not revise downwards?
So again, let me answer that. First of all, let me comment that this round robin is not some rampant. It was happening with a few institutions and a few developers. The point I'm making is, again, you must go back to the thesis of what's happening in the industry. In the industry, it is the few who are surviving, the others who are dying, but the death is getting elongated thanks to these NBFCs who are helping them keeping on moving the liabilities or keeping on doing the round robin. Where in fact, as I mentioned to you, what are we doing? We are in fact, the distressed guys are approaching us and we are helping them marry it to our good developers either through a JDA, sale of land or a DM model. That's the right way to go, rather than helping a distressed guy in round robin, which is actually prolonging the pain for the industry. So it's actually the reverse of what you are saying. We believe, because please understand what the industry is going through. Let me give a simple example to you which will make life simple. 5 years ago, if a good developer would launch a project at 10,000 rupees a square feet and a grade B would launch in the same micro market at 8,000, you would have bought it. You would have bought the 8,000 rupees. Today, nobody is buying. People are only buying the product where they feel they are going to get the delivery. The discount days are gone. So that's the point I'm saying. This round robin was prolonging the death of the developers whom we had identified as no more going to survive. So in fact, it is good for the industry.
Okay. Thank you very much and all the best to you, sir. Thank you.
Thank you. Thank you.
Thank you. The next question is from the line of Divanil Desai from Turtle Capital. Please go ahead.
Hi, good evening, everybody. I have three questions. So first one is on the liability side. I think what we are seeing currently, the situation, I think it looks like that eventually the exposure of mutual funds to NBFC has to be coming down from whatever it was to 35-40% to maybe a lower level. And hence an alternate way to get our liability has to be thought about. So what are your views in terms of, how this situation will evolve and how our liability mix can change or will change?
So I mentioned this in my talk, and in fact, this is not because of the present situation itself. It was the day when we got our reverse merger approved and we became an HFC that we had mentioned on the call that thanks to HFC, we will actually now start looking at alternative long-term sources of funds. And we have always been banking on the banks and less on the mutual fund. And even now, as you rightly have said, and I mentioned this in the speech, that we had already announced our ECB issuance, which is actually happening in this quarter. And we had mentioned on our FS day that we will be going for a dollar bond issue, which also we are in the final stages now of getting the rating, and we'll be on the road for the roadshow from January onwards. So you're absolutely right. We were very clear from the time we got our HFC license that ultimately we need to build a robust and a long-term sustainable credit lines with these alternate sources. So if that answers your question.
Sure. My second question is to Mr. Piramal. Sir, what I want to understand is that we aspire or we already have 20% ROE in our NBFC business. But if you look at our pharma business and our information management business, we are still short of it. So how do we see ROEs moving up in both those businesses over a period of time? Do we actually see them kind of getting to 20% kind of a range over a period, or do we have a slightly lower number in mind for those businesses?
See, a lot of the pharma business and the DRG, the information business, are actually, these are businesses which are outside of India. So there our threshold ROE is not 20%, we are looking at 15%. And we are working towards getting to that number. And we can see that year on year we are seeing improvement in the ROEs.
Sure. And sir, my last question is on our consumer product business in India. I think we did a lot of investment in both in terms of acquiring brands and putting up the distribution network. But we are yet to see the momentum in terms of top line and sales. So any sense on that as to what are the challenges there? And I think we were aspiring to be one of the top 3 or 5 brands in India. So any outlook on that would be very helpful.
So, last year has been a big year as far as OTC is concerned because there were a lot of disruptions in the system, mainly because of the GST coming in and the large distribution we had. Now I think this year onwards you will see that there is growth. We are committed to this business. We believe that the distribution that we have set up and the brands that we have should enable us to grow and be amongst the faster growing businesses.
Okay. Thanks. That's it from me.
Thank you. The next question is from the line of Lav Sharma from Lombard Odier. Please go ahead.
Hello. Hi. Thanks for the presentation. Just quickly wanted to understand about, you mentioned about Lodha prepaying some of their mature loans to you. So does it mean that the loan exposure has been reducing from Lodha? If you can comment on the numbers there.
Yes. So this is the period of what I took you through for 2.5 years. So our exposure has moved between 3,500 to 4,000 crores. and because every time we get prepaid, we also look at different opportunities. So, and that is why you see that the loan exposure has not, otherwise if we had not gone ahead with some new deals, we would have actually been less than half of our original exposure. So, it's at any given point, we are keeping on looking at new opportunities with Lodha. But again, the point I'm making is the trick lies in not giving money to Lodha. The trick lies in identifying the right asset, understanding the permissions, what you think will be the cash flow and the market, and that's why, you're getting prepaid, if I'm making sense to you.
Understood. So can you just comment what has been if you can indicate, what has been new dispersals to Lodha during the last quarter and maybe?
In the last quarter, nil.
Nil, okay.
Yes.
Okay, that's fine. Thank you.
Thank you. The next question is from the line of Kamal Verma from CLSA. Please go ahead. Kamal Verma from CLSA. Yes, go ahead, please.
Yeah. Hi, this is Prakhar from CLSA. Just had one question which maybe comes with a medium-term view, trying to understand that, there is a difference between risk and perception of risk, especially when you are a borrower in the wholesale market. Does this basically, does this event and the way the markets work make you rethink on, how big commercial real estate financing should be part of the book structurally? And structurally, does it basically bring down the ROEs on a reported basis that you would work with? Thank you.
So if you have seen what's happened, when you say commercial, are you talking of office space?
No, I'm just looking at it like,
wholesale.
Especially the construction space, yeah.
Yeah, so first of all, I'm sure you heard me talk about our different approach to construction finance, and I don't want to repeat that.
Yes.
Having said that, if you have seen, we have been saying this and we are demonstrating it in the last few quarters, right from April onwards, that actually the growth is being fueled from our corporate finance group, which is the non-real estate. Having said that, I think we are not shying away from saying that we won't do construction finance because we understand this space. We have demonstrated to you again and again and again that construction finance, or in fact even any other type of debt on the wholesale platform in real estate, needs a special type of underwriting to ring fence it, and which we have demonstrated in the last 4.5 to 5 years. So I don't think we are going to slow down on that, because that is something which proprietarily we have mastered the art compared to others, and that's what we keep on saying, that it is not giving construction finance by any other NBFC, and for that you need to really understand the nuances of that. I'm specifically telling you for that. So the growth definitely will come. Like today we are 74% is real estate. We have given a guidance that in the next 1.5 to 2 years we'll be actually 50% only. But that doesn't mean that we are slowing down. The other sectors are growing. The other verticals are growing.
Okay. And do you plan to make any changes to the way or to the nature of this 50% of the book where you want to bring in more of cash flow backed or LRDs over the construction finance, or you think given the experience you have here still makes sense for you to continue growing there?
No, I'm again repeating, the growth will continue in construction finance, but you have seen the growth in LRDs and cashback from the last 18 months has been growing faster than that. Whether it is the CFG, whether it is ECL, whether it is housing finance. It's just that the numbers are small, and every quarter on quarter we are demonstrating the growth in these verticals, and this will continue.
Okay. Got it. Perfect. This is very useful insight. Thank you very much.
Thank you.
Thank you. The next question is from the line of Piran Engineer from Motilal Oswal. Please go ahead.
Yeah, hi. Thanks for taking my question. Firstly, a legal question. Let's say a builder is dragged to NCLT, so does the SPV structure still hold, or are all lenders pari passu?
I am very glad that you asked this question.
Thank you.
As I said, that all our deals, or let me put it, 99% of our deals are in SPV where we hold 100% equity and we hold security and the whole mortgage of land and building. So it is actually bankruptcy proof.
Okay, that's good. Okay, that's nice to hear. Another question, some of your competitors have increased their interest rate on builder loans by up to 200 bips. And have we also hiked our rates similarly?
So I'll answer this in two parts. I mentioned that in the last few months or a year, we were grappling with a lot of NBFCs lowering the rate and not lending, or the rate was not in line with the risk-adjusted return. And we were constantly only charging what we believed is right. So obviously now with this, they have increased it by 200 basis points. Our cost of funds have gone by 0.5, that is 50 basis points, which we have passed it on to our incremental, which we have passed it on to our developers. So this again, let me just, say it in a different way. The borrowers have appreciated that we have been consistent in whatever we charge. It's not that, we were trying to undercut somebody. Now the markets have changed. So I go back to the borrower and increase by 200 basis points. We have been consistent in our relation with the borrowers.
And Piran, this also indicates that the increase in incremental borrowing rate for us versus the competition. So obviously, the ones who have had a higher increase in their rates, they obviously will have to pass it on, and not necessarily whether they'll be able to do that or not.
Understood. Okay, and in your borrowing mix on slide 34, there's this, others category which has gone to like 16% now, and it was like 0 a year back. So what exactly is this others? Slide 34 I'm referring to.
Those are ICDs and borrowing from corporates and other institutions, apart from banks and NBFCs and financial institutions like this.
Okay, and how much have we borrowed from our own group companies, if I may?
None.
Okay. And we've not sold on any loans this quarter, if I got that right.
No. We don't have plans. As I mentioned, we do it only for LRD, which even today will be picked up. We do it only for ROE purposes.
Okay. And also, could you update us on, all these several tie-ups we have with APG, Bain Capital, etc.? What's happening on that front? I think, is there any update there that's worthy of mention?
So on the APG front, I can answer. On the CFG, we just have to do one more deal and then the entire fund gets closed, $750 million between them. They are happy to, in fact, look at, as Chairman said, that these are perpetual providers of capital. So in fact, right now I'm not able to speak to you because of it will be of me to say it. But yes, we are in the last leg, the one deal, and then we are done with APG. And then we will look at a second round.
Okay, got it. It's a $750 million fund.
And as far as Bain is concerned, Chairman will just mention.
So Bain, we have a JV called the India Resurgence Fund. And we both put in 100 million each, Bain and us, and we are looking at several deals, and we also out to raise funds for $1 billion. Our strategy is that once we close a couple of deals, we will raise some more funds. And we have some very reputed blue chip investors who've already agreed to be part of this thing. And I think in the very near future, you'll see that we'll announce our first deal.
And let me add, since you asked a very good question on downselling, I think let me clarify that the downselling which we do in the non-real estate and even in the LRD is not necessarily to NBFCs and banks. Today we have already formed, I wouldn't call it a club, but a lot of providers of capital beyond NBFCs and the banks, who, in fact, let me share with you, as late as yesterday, were asking us whether we can give some more deals to them. So it is not necessarily NBFCs and banks. It's a good you asked so that we are clarifying. So today we have perpetual providers of capital, whether it's family office, whether it is pension funds, who are wanting, on an ongoing basis, deals underwritten by Piramal, they want to participate. So we do not see an issue. Tomorrow, if a CFG deal, we look at say, a 800 crore deal and we want to keep 400 and downsell 400, we can do it even in this market.
Okay, that's good to know.
Hi sir, this is Alpesh here. Just a follow-up question. In our press release, there is a goodwill increase of almost 700-800 crores. What is that regarding from March end numbers?
This increase is basically on account of the foreign exchange. Our closing exchange rate is higher than the March rate by 10%. So this increase is only because of change in the foreign exchange rate.
Perfect. And secondly, at the time of transition, we were expecting some of the loans which were there on the standalone balance sheet to be transferred to the NBFC balance sheet by end of December. What's the progress on that?
So that is in line with what we have committed. It's on track currently.
So what would be the outstanding on the standalone balance sheet as of now?
There is about 6,000 crores outstanding on the standalone balance sheet right now.
And that has to be completed by end of December, is it?
Yes. In fact, we have just recently, written to the RBI also, giving them the report, because this is in line with the understanding with the Reserve Bank of India.
Perfect. Thank you and all the best.
Thank you. The next question is from the line of Trupti Agarwal from White Oak Capital. Please go ahead. Trupti Agarwal, your line is unmuted. You may please go ahead with your question. Hello. Ma'am, you may have to speak closer to the phone. We are unable to hear you. Better now? Hello. Hello. As there's no response from the current participant, we move to the next question. That's from the line of Ravi Mehta from Deep Financial. Please go ahead.
Yeah, thanks for the opportunity. Just one small question. When I look at your half-yearly balance sheet, under the current liabilities, the borrowings and the other financial liabilities is a very big amount of 24,000 crores. And somehow when I look at the slide 30 of ALM mismatch, I couldn't reconcile those numbers. So can you just help me understand when am I missing out on that?
So since the question is very specific to some specific numbers, we will get back to you. So, you can reach out to us separately and we'll clarify that.
Okay, thanks.
Thank you. The next question is from the line of Lalaram Singh from Vibrant Securities. Please go ahead.
Hi, do you want to comment anything on the recent articles stating we might look into divest the pharma business?
I think I made that comment. Every few weeks, either we get a rumor in the newspaper we are buying something or selling something. So we don't just comment on this.
Okay. Thank you.
Thank you. The next question is from the line of Trupti Agarwal from White Oak Capital. Please go ahead.
Yeah. So my two questions are, one, can you please tell me what is the average cost of funds for the second quarter? And two, what is the amount of funds that we would have raised in the short-term market post the quarter?
Our average cost of funds for the second quarter was 8.6%.
Sure.
And the funds that we have raised post 30th September is close to 1,500 crores.
1,500. Sure. And sir, if I'm not mistaken, you've been saying that the incremental cost of funds, that the increase is about 50 basis points. That's right.
Absolutely.
Yeah. Thank you.
Thank you. The next question is from the line of Siddharth Modi from Value Investments. Please go ahead.
Hello.
The current participant has got temporarily disconnected. We move to the next question. That's from the line of Vinod Jain from WF Advisors. Please go ahead.
Sir, the dynamics of construction activity and real estate prices is assumed to have a linkage. I wish to know your view on Indian real estate prices going forward. And also, sir, what view do you have on construction activity levels going forward? I would appreciate your opinion on this.
So again, let us first go back to what we have been saying, and then I'll answer your question. That if you really look at it from the outside perspective today in real estate, you will find that most of it is standstill, any city you go. But if you go inside the industry and understand, it is these few developers who are actually constructing at a very fast pace. Lodha, we gave you an example, is just one of them. We can give you several examples where they are actually now moving faster than even what they used to do before in construction. So that is happening. From the outside, because you see the 90% also together, you are not able to appreciate that. So
I see, sir.
So construction is actually going very well for good developers. Trust me on that, whether even in the worst market of Gurgaon and Noida, with good developers, construction activity is actually doing very well. In fact, I would like to also share one more data point with you all. While there's a lot of talk right now we are having on this liquidity, etc., and a lot of questions being aired on real estate, on the ground, in this quarter has actually been the best quarter after years for the good developers again. I mentioned to you the 26% growth of our developers.
Yes.
This is fueled by the worst performing market in the last 3 years, NCR. It has grown by 2.5 times. Just to share the data point, this is the first time we are seeing in this quarter has actually grown. So the point I'm making is that good developers, in fact, if you really go deep, while we are saying prices are not increased, prices are actually increased by 5 to 7% recently for the select good developers, because it's a flight to quality developers. People are ready to pay for construction and good quality and their money is secure. So that's what is happening. But from the outside, if you look at it as a layman, you'll find a lot of projects stuck. And that's why you are asking this question.
Very well, sir. Thank you.
Thank you. The next question is from the line of Siddharth Modi from Value Investments. Please go ahead.
Hello, sir. My question is regarding our corporate portfolio. Can you set the average rating of companies that are there in our corporate finance portfolio?
I mean, what are you trying to ask when you're asking average rating?
Yeah, so I mean, do we lend to only AAA rated company or do we lend to any AA rated company? I mean, what sort of companies that we do lend in the corporate finance portfolio, our corporate finance portfolio?
So again, the philosophy remains the same. That at the end of the day, as I mentioned, what is the philosophy? Who is the promoter at the other end? Very important. How is the company performing? Is this company going to grow in the future? Does it have corporate governance? And is it in the sector which we believe is growing? So let me take a minute since you are asking this question, though we have mentioned this several times. So when we say that we are sector agnostic on the CFG platform, which is the corporate finance group, what do we mean? We proactively as a team identify a sector. Last time I shared with you all 6 months back that we have identified logistics as a sector which will grow after the GST came in. Many would recall. And the team studied it for more than 30 days, got internal experts on logistics, then drilled down to the promoters whom we believe will grow, and then went with solutions to those promoters. And that's how we create deals. It's not plain vanilla. As a lender, you go and say, okay, would you want to take money? If I'm making sense to you.
Okay, and sir, my next question is, where do we see this liquidity situation easing out?
I think, as I said before, there is enough liquidity in the system. It's the confidence that the banks and mutual funds need to have for funding NBFCs. And I see that there are some measures being taken both by RBI and government. And so let's be hopeful that in the next few weeks you'll see some more liquidity in the system.
Okay, sir, my concern is if the lower rated NBFC or the not so good quality NBFC, if they are unable to refinance, do you see that effect playing out for the whole sector, the same that played out for the IL&FS? I mean, this is the worry. I mean, if any small NBFC go default, then, the market again will pay the whole NBFC sector with the same pen. So, I mean, I worry regarding this particular thing.
So I did answer that question. I think on the ground what is happening is that the lenders are also giving to quality NBFCs. The markets are overreacting, but I think once the markets also understand that the good NBFCs are actually doing better than before, I think there will be a flight to quality both by investors as well as the lenders. That's all I can say.
Okay. Thank you, sir. That's it from my side.
Thank you. Ladies and gentlemen, due to time constraint, we move to the last 2 questions. The next question is from the line of Ravi Mehta from Deep Financial. Please go ahead.
Hello?
Yeah, please go ahead with your question.
Yeah. Now, one quick question on the equity on lending. When I look at your slide 15, so what I'm seeing is there is a good jump in the loan book size and also the profitability of the company is intact. But when I look at the equity on lending, it is pretty flattish. So can you help me understand that?
What is the question? Sorry, we didn't understand it.
The loan book is growing at a good pace and the profitability of the company is intact. So technically the equity on lending number should increase. I mean, as the profit gets added to the equity on lending. But when I look at the slide 15, I think the number is pretty flat. So
no, on the contrary, as Chairman mentioned, equity has been over-provided, and that's why if you see the debt equity is low. So in fact, today, if you see the equity is already 9,900 crore. What's the debt equity? 4.4.
It was similar last quarter also. So
the profit for the year has not been
okay.
The profit for the year. So this includes dividend payout.
Yeah.
This is after dividend payout.
Yeah.
Okay.
Last quarter, there was a dividend payment that had happened.
That's why.
Okay. Thank you.
Thank you. The next question is from the line of Vivek Joshi from Bandarpoj Capital. Please go ahead.
Hi. My question is regarding the foreign source of funding, the ECBs and the dollar bonds. What is the rationale? Is it the tenure that is longer, or is it like the cost of funds, or is it just pure liquidity that is driving this decision?
No, as we mentioned to you, this is not a decision driven by today's environment. We had mentioned to you all in August itself that once we became an HFC, we got an additional window of ECB. I think somebody else also asked us this question, and we have always constantly, I think we have always mentioned this, that in our financial services business, more important than asset is the liability management and the diversification of our borrowings. And we have been pursuing this on a steady state, on a regular basis. So that is why it's not only the tenor, of course it helps in the tenor, it's a 5-year tenor, plus today we definitely are not going to get a cost benefit, but it definitely provides liquidity, another source of funds, and long-term source of funds. But it was a part of the plan which we actually shared with you all in August itself.
Okay, thank you so much. That helps. All the best.
Thank you.
Thank you. Ladies and gentlemen, with this I now hand the conference over to Mr. Hitesh Tata for his closing comments. Over to you, sir.
Thanks everyone for joining the call. Please feel free to reach out if you have more questions to us. Thank you.